All right. Good morning, good evening, good afternoon, everybody. This is all very casual. As soon as we're filled up, Scott's just going to take straight over. Oh, wow, this room is filling up great. Hey, Dave Sharpe. Yeah, good afternoon to you, sir. Sun shining where you are, Dave? All right, and Scott, I reckon that's good to hand over to you.
All right, everyone. Nice to see you all here on a Sunday morning, 6 a.m. here in Thailand. Apologize for the delay. I don't know, it's a bit early in the morning, it's a bit dopey. So today what I'd like to do is, first of all, I'm going to open up the floor to questions. And then I thought we'd get a little bit nerdy on the mathematics of volatility targets, and we'd start to explain exactly how you choose the right risk profile for you. So there's a lot in that. And my purpose here today is to make sure that if you're going to do this, that it's right for you. So this is a multiple year plan. This is not something that you should do or expect to get a return next month. And why is that? That is because right now we're running at a 1.81 Sharpe ratio. That's probably a little bit better than we can expect in the real world. In the real world, we can probably expect a Sharpe ratio of about 1.5. How do I come up with that number? And I'll cover what it means in a second. How do I come up with that number is that we can get the Sharpe ratio to about 1.2 in traditional finance markets. So it's reasonable to expect that we're going to do a little bit better than that in crypto, because crypto is riskier. Now, a Sharpe ratio of 1 means that you have, for example, 20% annual returns with 20% annual volatility is a Sharpe ratio of 1. 10% annual returns with 10% annualized volatility is also a Sharpe ratio of 1. 40% Sharpe ratio return, 40% returns on average with a 40% annualized volatility is also a Sharpe ratio of 1. So what Sharpe ratio is, it's a way of traders to measure DIX, that is leverage invariant. And so when we apply, for example, if you own Bitcoin for the last 10 years, you've made a lot of money, but you've made a lot of money by going up and down and up and down and up and down. Overall, the Sharpe ratio of Bitcoin is just 0.81. So this is the number of trading days, and this is a simulation with a distribution of Sharpe ratio of 1.5 results. So you can see if we look at the first 50 days, which is this block in here, the results are all over the place. So here, this is our true Sharpe. The green line is break even. So you can see that after 50 days, third of the time, going to lose money. Every now and again, you're going to lose a lot of money. Every now and again, you're going to make a lot of money, but it's really over 50 days, it's a very slight tilt on random. By 100 days, well, we're looking better, but you still, all the ones below this dotted line are doing worse than average. And all the ones below the green line are losing. So at 100 days, you still shouldn't be concerned, even with a very, very, very high Sharpe ratio strategy like ours, that you're not making the money that you thought you were going to. By 200 days, this all kind of sorts itself out, and you have some results on the simulation that are much better than what we thought, and some that are a little bit worse, and some that are actually losing money. But by 300 days out, you'd have to be really unlucky to lose money. And that's basically what it is. You know, the longer you go, the more this comes into a pattern of variance around the true Sharpe ratio, which is this yellow line. Okay. Dave has an excellent question. In order to minimize the risk of any one exchange failing in the future, can we run our Finrev account from multiple exchanges? Yes, you can. There's also something else you can do. You can, Normally, we're not going to allow people to do that, but for the launch, yes, absolutely, you can trade on 2 exchanges at a time, and that's very bright. The other thing you can do is, if you're worried about an exchange going down, which obviously you should be, you can use a higher volatility target than you would otherwise do, and not put all your funds in the account. So let's say you had $100,000 to trade, you would put $30,000 each in 2 exchanges and keep 40,000 off to the side. And that way, if an exchange goes down, it's a gut punch, but it's not cutting your head off. Now, the advantage of trading positively skewed trend systems is that in the event that an exchange goes down or something bad happens, we are mechanically convexly exposed to that. So in your surviving exchange, you'll probably do very well. Maybe you won't quite do well enough to cover the funds that you lost, but it won't be a disaster. Any follow-up questions on that, Dave? That was a really, really good question. Also, our development plan, which I'll get to today, is to add distributed exchanges. Now, the distributed exchanges right now, yes, last week the open interest on GMX was about 69 million. So it's enough to trade now, but it's not going to be enough if I go and onboard 10,000 people. Distributed exchanges completely solve the exchange problem. They also give you another advantage, which is that the tax office, wherever you are, doesn't particularly understand what you're doing, and there's no know your customer requirements, and it's semi-anonymous. So that can be a good option. It also comes with some downsides. The costs are slightly higher. So distributed exchanges are the next ones we're gonna run. Ben, yes, we have another exchange. We have an exchange support list. Caroline, would you mind adding the exchange support list order, please? I'm in favor of adding at least 1 distributed exchange fairly soon, but you know, Kraken, KuCoin, MEXC was our second choice above Bybit, but MEXC shut down their external API for us. How long have we been doing digital coin trading like this? We've been doing it for 10 months in our own account, and the return last year was about, the return over that 10 months was about 20-ish%. We made a mistake and had our real money running on FTX at first. And when FTX started to go down, it was like, oh, great, we're making all this money. And then we're making all this money. It's Hotel California. You're up, but you can never leave. So that was a fuck up. Then we switched it to Binance, and we've just started on Bybit a couple of weeks ago. Mark, how many coins are traded? So this is an interesting question. Our methodology is we're trying to add every coin which is liquid enough that we're not going to be more than 5% of the daily volume or 5% of the open interest, and has 365 days of trading history. So we won't be trading new coin listings. And there's a good reason for that too. Just like in the real markets, many IPOs are pump and dumps. Many new coin listings, as we know, are pump and dumps. We don't want to get involved in that noise. That's not our jam. So anything that's been there for 365 days, and that's going to be slightly different on every exchange. You know, the more shitcoin exchanges are very aggressive about adding more coins. KuCoin, for example, has a great coin list. And the more sort of legit, trying to be legit exchanges have a less coin, have a smaller coin list in general with trend following. And we can cover the maths of this if anyone is interested. Adding more coins continually improves the Sharpe ratio in a diminishing marginal returns way, but this is the easiest path to trading system performance. Mike, what does the strategy do for different level volatility? We're going to cover that in really, really exhaustive detail today. Tom O, is that Sharpe showing returns -0? It's showing Sharpe -0. So let's go back to this, which we can see. So after 300 days, this is our true Sharpe over a 500-day sample. this is the Sharpe that this is the dots are the Sharpe that you're going to be showing over like 1,000 different simulations that we ran. So if your true Sharpe, every true Sharpe on a simulation is a dot, and that's just the way it is, man. I don't want to pretend that this is mechanical, like you put in your money and it slots out more money. That's not the way it is. We earn returns for taking risk. There is anyone who tells you that you can get returns that are absolutely certain is lying to you. Returns are highly uncertain. That's why we get paid. At the end of the day, most people are risk averse, right? Most people don't like taking risks. Most people prefer to have their money in the bank where it's safe. Because of that inherent risk averseness, which comes from our DNA. Your DNA comes from you sitting around a campfire on the African savannah. If you're sitting around a campfire 100,000 years ago, you break your leg, you're going to die. So most of us have a deep, deep, deep unwillingness to take on risk. So systemically, risk tends to be mispriced in a behavioral basis. And this is all we're doing. We're not trying to identify mispricing. We're trying to take on risk that other people don't want. Okay, I've tried accessing, I'm not a technical person, but we have plenty of people doing that. If they, David, if they make a VPN illegal, we would immediately switch to distributed exchanges with no KYC requirements. What was the max drawdown over the last 10 months? Let me pull it up for you, man. The last year you want to draw in? All right, let's bring it on. Here we go. Max drawdown. 8.46% was the worst drawdown, and that was from there down to there, I think. Long drawdown, 268. Any plans for Woo? Yeah, I really like Woo. All right. Okay, Jack Chin, excellent question. What is the minimum amount do you suggest to use the Finrev system? We have used it with small accounts. Like when we were just getting buyback going, we just put $1,000 in to see that it all works. And you can definitely trade it with small amounts, but every exchange is different, but every exchange has a minimum transaction cost, and that starts to bite into your returns quite substantially below about $5,000. So, and also the system costs money, and you know, you need to make enough money to actually make it a very good, very, very attractive proposition. You can't like invest enough money to make the money that you paid for it back if it all goes well. That's a stupid idea. You shouldn't do it if you're planning on doing it with a smaller money. So I would say a minimum of 5,000, and ideally I'd want to put 10,000 in to make a life-changing sum of money. And we're going to do some simulations so you can see how that all works out. Robert Saunders, any plans for Woo? I love Woo. I think it's a great exchange. I am slightly concerned that the market makers there are a little bit predatory, but you get a lot for that. Is this essentially a bot? Well, there's lots of bots. A bot covers everything from like a stupid 3 commas thing, which is guaranteed to lose you money, to Renaissance technology, which is, you know, everyone who works there is a billionaire now. So it's a bot in the same way that, you know, any piece of software is a bot, but it's not some stupid like MetaTrader 4 plug-in bullshit. This is the kind of thing that would go on in the back end of hedge funds, not in the back end of retail things. Okay, David points out that banks are not safe. This is an excellent point. Like people who really, really try hard to avoid risk often end up taking more risk than they think they're taking. So, you know, the buy and hold guys, It's like, oh, I don't want to get involved in that. There's too much risk in that. They stick it in buy and hold, and one day they have a 60% drawdown. You know, the nature of life is risk. What we're trying to do at a philosophical level is get the most amount of return for the risk that we're taking, and also to take the level of risk that's appropriate for us. And we're going to talk a little bit about that in a minute. Mark, can we briefly run through the 6 trading signals again? How did we come up with them? Yeah, that's a fucking great question, dude. Any excuse to nerd. All right. Let's look at Bitcoin. Okay. Let's look at it recently. All of the dots are a different signal. Our 6 different signals are blended. I'll cover the weighting in a moment. The top one is exponentially weighted moving average crossovers. Now, it might surprise you to know that these are by far the most common signal in the professional CTA trend following world. The particular signals that we use are the same ones that Man AHL use. We started with those, and we use a 2-8 crossover, a 416, a 832, a 1664, and a 30. Let me find exactly what they are. Signals. Okay, what have we got? We've got a 2-8, a 416, an 832, a 1664, a 32 128, and a 64 256. Now, the difference between those is not immediately obvious. So a short. Now, we're not just going in when it crosses over long over short. What we're doing is we're computing a signal over. We're computing a signal from the distance between those 2 moving averages. And when I explain this, this is going to become. So we're computing a distance between the top moving average and the bottom moving average. We're scaling that so they're all invariant. We're doing it after cost, because a fast moving average crossover will take many trades. It will jump in and jump out very quickly, whereas a slow one will get in and ride the trend for the long term. So the slow ones tend to do better. Now, this one is exponentially weighted moving average crossovers. This one is the distance to a 2 standard deviation Bollinger Band, Bollinger Momentum. This one is breakout, and we use 10, 20, 40, 80, 160, and 320-day breakouts. This one is Laurent Bernoux, our excellent friend and co-worker. His floor ceiling, it's a regime detection methodology that he used from his days at Fidelity Hedge Fund. He actually came up with it, and it's in his book, which is. If you look at Laurent Bernoux on Amazon, he's got an excellent book on systematic short selling. This one here is normalized momentum. So what we're doing is exactly the same as moving average crossovers, but we're smoothing the signal before we're computing the signal. So this is an idea from an ex-Man AHL trader called Rob Carver. And this one is MACD momentum, which is not quite MACD as you understand it. This is another one that we stole from Man AHL. They published it in one of their traders left and published a paper about that, and we found it. There's 2 others that we could consider adding. The first one is the one that we use in the automated wealth creation engine, which is a slope of a linear regression line, and the other is a very common one, which is just rate of change. By the time we have 36 now, because each one has subsystems. By the time we got to 36, we were kind of, every additional system doesn't add that much juice unless they're uncorrelated. All right. Does that answer your question? Yes, you can pay it in installments. How many trades might you expect to take every day, month, year on average? That's a really good question. So if you look at this, we're not taking trades as you might understand them. So what we're doing is we're taking a position, and this is more like, so these are our positions. So what we're doing is we're taking a little bit more position or taking a little bit less position, adding a little bit more, taking some off, adding a little bit more, taking some off. So we're taking a continual position in each market that we trade. And we're trading a lot of markets. And so what we're doing is, so if you consider this a whole trade, we're getting short here and we're staying short to some degree until about here. But that short position wiggles up and wiggles down every single day. Now, why do we do that? Because if you have a stop loss, it's a stop loss is a necessary evil for a discretionary trader or a manual trader, but it's inefficient because we probably don't think that the trade is good and then it hits the stop loss and then now it's bad. That's probably not our real authentic how we view things. So what we're doing by having a continuous signal and wiggling our position up and wiggling our position down is we have something that's closer to reality. So if you think about how you would actually think if you're trading this section of price action here, like I'm happy to be short here. I'm getting more confident in my short.
Hey, sorry, you're not sharing screen at the moment, dude.
Fucking idiot. Sorry, man. Thank you. Where am I doing that? Sorry, guys. Okay, so let me start again. So if we think about, you can see my screen, right?
We can, yeah.
So if we think about this bit of price action here, at about here, I'm happy to be short, but I'm not real confident yet. I don't want to like jump in balls to the wall short. I'm getting more confident as the market's going. I'm increasing my position. This is my position size. This is my signal strength. I'm increasing my position size. Oh, maybe it starts, maybe I'm wrong. Oh, maybe I better take a bit off. Oh, I'll add that back on. Add that back on. Okay, now things are going good. Now let's get short. Let's get fucking real short. And then as it looks like it might reverse, you want to be a bit cautious, take some off. And then it goes your way and we're adding it back on, adding it back on. And what happens down here? It's still good, but I'm not so confident anymore. Maybe it's going to be good. No, I better take some of that off. And you can see by the time we eventually get completely out, where the bulk of it out, we're out of the bulk of it by about here. And what happens if, you're wrong and the market hasn't reversed and it's going to go back down like it did? Well, fuck, we just get short again. And so this is a far more efficient way of doing things. And this is the way that the vast majority of what you'd call the top tier firms are going. Kevin, are we just beginning a great crypto run? Well, historically, my crystal ball is kind of shit. And I've got to be honest about that. So where are we now today? The algo thinks we should be long. We have been long since here. I'm happy to be long. It looks like it's going to go up. It feels like shit to be long, and I am long, so that's usually a good sign. Usually when I feel comfortable about being long, it's a sign that I'm about to get fucked. So cautiously, I don't know, but I think it looks good so far. I am long. Okay. So Eugene Greco has an excellent question. Will the system be liquidity hunted if the system gathers a lot of users once we go public? This is a major problem for other bots with copy trading. This is actually a deal breaker for other bots with copy trading. So ultimately, any system that people can work out what you're doing creates an opportunity. So there's a couple of reasons why people are unlikely to try and do that until we get sort of $50 million online. And the reason is that we're not jumping all in and all out of positions like, say, the copy trading bots do, which create a very big steal their alpha opportunity. The what we're doing is we're wiggling up our position a few percent a day. So if you consider, if you had $100,000, if you had $100,000 in the system, the average use of your capital would not use all of that $100,000 because the volatility is so high in crypto. You're probably using about $20,000 on $100,000 of capital in $100,000 basis at a normal volatility target. And that would be spread over 100 different accounts. So using $20,000 over, say, 100, let's say 100, it could be 200 different positions. So let's call it 200 different positions. You've got $200 worth of position in a lot of different things. And then of those daily $200 positions, you're wiggling them up or down 5 or 10% a day. Now, the opportunity to front run something like that is very minimal. Now we have some KPIs in our system to see the difference between the price that we want to get filled at and the price that we actually get filled at. And it may be that one of our users figures this out and starts to get a bit funky with it and tries to fuck everyone. We will notice that within a day. And we've got a plan to attack that. The plan is immediately we spread our orders out over the day, which is probably better anyway. And we do that right now. Our order execution is, if the order is big enough that it can't be filled at the bid or at the offer, we split it up into what's called parent and child orders. So we break your already small order up into multiple different small orders, and we space them out because we don't want to continually jack the price as we're buying. We want to buy a little bit, let it come back to normal, buy a little bit, come back to normal. So it's the effect of a VWAP bot. That is a really good question. It is definitely a potential problem. It's a potential problem for all automated trading systems, and we've got a very, very robust plan to deal with it. We haven't seen it so far. It's less likely to hit us than other copy trading bots. But yeah, it's definitely a thing for all automated trading. You have to be all over it like a fat kid on a Mars bar. What version of the software are you on? Well, it's been a continuous. We haven't done it like version 1, version 2, version 3. We didn't build an MVP and then build it out like that. We built a production version of the software right from the start. So our VP of engineering, he's a guy who's got awards for developing online banking software. So we built something that was robust and scalable right from the start. It's been running on our own real money actually for 11 months now. It hasn't thrown a bug. We had one small bug with Bybit when we onboarded a new exchange. Tamara, what do you get for tax reporting purposes? You get a CSV, but what I suggest you do is what everyone should do is one of those online crypto tax things that you spit in your exported CSV file and it spits you out a tax report for your country. That's definitely 30 or 50 bucks well spent. Okay, so Mark has an excellent question. The model is trained on historical data, as are all models. As the market evolves over time, is there a strategy to avoid model drift? Okay, so this is, fuck, we got some smart people here. Okay. Yes, there is a strategy, because I'm not a dickhead. Okay, so let's consider Bitcoin over time. These are our different signals. This is moving average crossover, breakouts, and all the rest of them. All those signals are not created equal. It so happens that 80% of the trend following hedge fund world just uses moving average crossovers, and you can see why. They're fucking better, right? They perform better. What do we do with a signal that performs better? We give it more weight. What do we do if this signal starts to degrade, like it degraded here slightly? We give it less weight and we give more weight to the other signals. So if in the future moving average crossovers for some reason stopped working, they would be given less weight. If for some reason this one started working much better, they would be given more weight. Now you can see that at the start of the year, Bitcoin was 3.5, 4% of our portfolio. Why? Because Bitcoin launched first in the big rally that we've got, right? So when Bitcoin was outperforming all these other coins, Bitcoin led the charge. It was getting much more weight. As the alts have taken over, you can see that Bitcoin is getting less and less weight as time goes on. Now, if we do that same thing with breakouts, our breakout 320 was the top performing signal because it's after costs. So a breakout 320 after costs tends to outperform shorter signals. Like these ones have hardly any weight compared to breakout. And we do this with all these signals. These get reweighted once a week. So if a signal downgrades or stops working, we have a very robust plan to deal with it. And if we look at today, Bitcoin dominance futures is our bullish thing. These are all quite bullish, but we've got plenty of bearish ones as well. Fucking BSV, fuck you. Really good question, Mark. Dave Bowker, is this scalping? No, this is not scalping. So this is what we call medium-term trend following is the sweet spot for momentum trading. So we're looking at trading. Let's have a look. Let's look at a price chart. Let's pick something. I haven't seen in a while. Let's look at ADA. Okay, so ADA, we go short on, sorry, mate, 22nd of February, 23rd of February. We're out of that short a month later. So we're looking at, here is a much longer trade. We go short the 5th of November. We're out of that short 9th of January. So a couple of weeks to a couple of months is our typical trade time. Mike Winkle, are all strategy decisions done on a coin by coin basis? Okay, so this is a very interesting thing. What we're doing is we're not predicting the market at all. What we're doing is listening to the market. When the market starts going down, our algorithms are descriptive measures of how strong the trend is. We know, because it's been this way in every single market, from FX to stocks to bonds to gold to everything, in every market in the world over the last 200 years, we see evidence that when things start going down, an object in motion has a tendency to remain in motion. And this is for a number of behavioral reasons. And because it's behavioral reasons, that people like things that are going up and they hate things that are going down, and they like making money and they get excited when they make money. For all of those reasons, positioning in trends tends to be sticky, and this is the source of our returns. So what we're doing is we're taking a descriptive measure of trends and turning that into a position size. If our trend is down, we're just going to ride the trend. If our trend is up, we're going to ride the trend. Laurie, is anyone else in the US concerned with what the SEC is doing? Typically, more uncertainty about the market is more risk premium in the market. So as long as they don't shut our things down, which it's unlikely, generally this means a higher on average rate of return, because as long as crypto remains toxic to institutional investors, there is a definite risk premium there. Are the signals only taken on a daily time frame? Great question. Yes, they are. I can show you some data on when we tried to do it on shorter time frames if you guys are interested, but it didn't work. Okay, Tom O. If I say I want 10K in the coins, Tom, that your question about how much should you deposit, it's going to be clearer once I do go through the volatility targeting thing. Reed, from your end, how much time per week? You could switch this off and come back in a year and not actually check it. I would advise not checking it. like, it's going to do what it's going to do, regardless of what you do. All you can do is generally fuck it up. Like the problem in trend following always works out in the end. It's very, very difficult to fuck it up. The only thing you can do is, oh, it's made so much money, I better put more in now. That's generally a stupid thing. And because it makes money in very short periods. Or, oh, fuck, it's losing money, I better pull some out. I could put in this other thing that's better. And that's generally stupid too. Robert Saunders, is the API looking at execution of all orders as a whole and just executing them per account? Yes, it is. We keep an eye on the total liquidity for everyone together, because together we're all moving. We want to make sure that we don't move the market. The idea is that that as little as possible, we don't want to give anyone an opportunity to front run us, to fuck with us, to figure out what we're doing and take some of our profits. This is a real question. Okay. Does it work on future trading with Binance? Yes, it does. Okay. Okay, Tim, everyone gets a mentor who's not like a customer service monkey in a call center, like one of these actual traders. Simon, no, $100 isn't going to work for you. All right, guys, now let me move on to choosing a volatility target, because I think this is going to clear up a lot of your questions. All right, let me do this. Okay, you guys can see my screen, right?
We can, yeah.
All right. Okay. So this is something that I take really seriously, that we all take really seriously. What is the goal? The goal is to get rich. You can't get rich if you can't take the heat. Our obligation is to educate you guys to make the right choice. What's the right choice? The right choice is the choice that helps you succeed. Now, every person is different. People have, I'm a very risk-takey type of guy. I can handle a lot of heat, more than most people. You might not be like me, and you shouldn't force yourself. Your income has a big impact on it. If you have a high income, you can withstand drawdowns, and it shouldn't really bother you as much as someone who's trying to live on this. Everyone has a different asset mix. If you have a lot of buy and hold crypto, this tends to move in the opposite direction. It tends to be non-correlated with buy and hold crypto. So it gives you a huge advantage if you're mixing that together. If you have a lot of stocks, this has a diversifying effect too. Depending on your asset mix, you may be able to go to a higher volatility target. Everyone has different needs and goals. So some people might think, oh, I'm going to make $100 million. Like, I'm not. My actual number is $20 million. As soon as I have $20 million and I'm at 4, I'm going to drop the mic. You won't see me for dust. I'm out. I sell the company, I'm gone. Everyone has a different time to retirement. If you're 25 or 30, you really can and should load up on risk. Why? This is the time to take risk. If you're 55 and retirement is a freight train coming, you don't want to take the same sort of risk that someone else would take. And the last thing is the correlation to your existing asset streams. And what I mean by that is, let's say you're a housing contractor and you've got a fantastic small business that earns you 300 grand a year. It is likely that if we get a recession, your stocks go down and the income from your small business goes down at the same time. Those income streams are correlated. So there's no point in having a plan that in theory maximizes your returns if you're not going to be able to stick to it. And investing on the hard right edge of the chart is very, very different than looking at a historical chart and saying, oh, I would have been able to handle that. I would have been able to handle that. You know, I was there in 2008 and I puked in 2008 at the wrong time. And everyone looks at the chart of 2008 and goes, wow, I just would have bought right at the lows. And, you know, I was there and I was in daily contact with a bunch of real pros. And I sold and I didn't buy, and none of the people I knew bought at the lows. So if you think that you're going to be able to do that market timing magic and you're the next coming of Paul Tudor Jones, grow up. probably got to be a bit more humble. So if we give our clients a plan that they won't follow when things get hard, they get the worst of all possible worlds. So they don't get the advantages of systematic trading. Systematic trading is great because you're pressing a button, you're coming back in a year, you're seeing how much money you made. Fucking excellent. No work. But if you can't follow that plan, then you don't get that advantage. You just puked out at the wrong time. And they also get the worst advantages of discretionary trading. So if you're discretionary trading can make a lot more money when things are going good. But when the emotions get high, you tend to make stupid decisions because people are stupid. And in fact, a person is mostly not stupid. But if you put us together in big groups and make a crowd out of us, people are always stupid. You put me in a crowd and I'm part of a stupid mob. And this happens in trading. The plan has to be realistic enough that you can stick to it. It needs to have a high probability of getting you to the wealth you want. And that starts with a clear goal and a realistic plan to get there. And the point that I want to make is you probably do have enough. If you compound at a high rate, and the really important shit, the important ingredients of the soup, compound annual growth rate and time. The real problem is that a large drawdown hurts compounding a lot. You get a 50% drawdown, you need 200% to make it back. You get an 80% drawdown, you need 400% to make it back. So this is our compound interest calculator. And at 30% compounding, starting with $10,000, after 5 years, you've got 37. After 10 years, you've got a 13x return, you've got 137. At 50% compounding, your 10K is 61K after 5 years. And 332K after 10 years. That's a 33x return. At 100% compounding, which is at the upper scale of our projections, after 5 years, your 10,000 has become 320 grand, and your 10 grand after 10 years has become 10.2 million, 1,024x return. So I'm sure most of you are thinking, oh, that's great. I want the 1,000x return. I want to be an eight-figure guy. It's not that simple. So we need to cover some foundational concepts first. Just bear with me while I get nerdy. We're going to understand volatility, Sharpe ratio, the limitations, and the Kelly criteria. So volatility is the amount your account wiggles up and down. And a big difference between professionals and amateurs, amateurs think about what percent did I make, whereas professionals think what was our return relative to our risk. So risk is what you buy return. So Sharpe ratio is just a quick and dirty way for professionals to measure DICs. It's not the formula, but it's easy to think about it conceptually as returns divided by risk. It's invariant to leverage. So what I mean is a trading system earning 20% with a volatility of 10% has a Sharpe 2.0, and a trading system earning 40% per year and a volatility of 40% has a lower Sharpe ratio. So which investment do you guys prefer in the chat? A bond fund earning 8% per year with a 2% drawdown, or Bitcoin purchased in 2018 for 15,000, or a trading system that makes 50% per year with 30% drawdowns? Which one do you think is the best? Which one do you think is the best investment? Benny, yeah, there is a payment plan, of course. The bond fund is actually the best one. Okay, so a Sharpe ratio of 1 is more than 95% of hedge funds. So let's look at some other types of Sharpe ratios. Treasury bonds, 0.36. Buy and hold stocks, 0.4. Old style trend following is about 0.55 to 0.7. Warren Buffett did 0.76. So this is the range of sort of traditional investments. Bitcoin over a 10-year hold did 0.81. Ray Dalio and George Soros around the 1 mark. Traditional markets, volatility targeted trend following, the modern version, basically what we're doing on TardFi markets is about 1 to 1.2. Our system has done 1.81, but I think 1.5 is a more realistic estimate going forward. And the really big boys of the financial world, the greatest ever to do it, and it's not even close, they're like 50% better than the next people. Renaissance Technology, Jim Simons, they hire a bunch of the best mathematicians in the world. Most people who work there are billionaires now. They've done 66% return after fees, and their fees are 5% of capital per year and 30% of profits. 35% profits now. And they've done a Sharpe of 2.5 after fees. No one's ever gotten close to this and no one ever will. They're the greatest ever to do it. So where are we? And high frequency traders in a year, they would be profitable on like 280 days out of the year. So they rarely, it's unusual to have a losing day for them. So high frequency traders have the highest Sharpe ratios that you can possibly imagine, but they are capacity constrained. So if we look at from 85 to 2000, this is Windsor, which is a big hedge fund, did 0.62. Berkshire Hathaway, Warren Buffett did 0.64. George Soros, 1.02. Tiger, Julian Robertson did 1.06. The Ford Endowment Fund, very pro-level, multi-billion-dollar family office, 0.96. Harvard did incredibly 1.15. The S&P 500 in a good period from 85 to 2000 did 0.98. US Treasuries did 0.36. And inflation was down a bit. So those are that's kind of what a good Sharpe ratio is. And Sharpe ratio has some problems. Treats upside volatility the same as downside volatility, which penalizes trend followers. And why? Because we're big spikes to the upside, which are good, but lower the Sharpe ratio. And it doesn't take into account skew, which we're going to cover. A system that has positive skew, meaning that when the shit hits the fan, it goes up, not shit the bed, is very, very desirable. So generally, if faced with the choice of a negative skew Sharpe 1.5 system and a positive skew Sharpe 1 system, you might well choose to have positive skew just so you can sleep at night. And so positive skew systems, they tend to go sideways for a while and then have big jumps up. Sideways for a while, big jumps up, sideways for a while, big jumps up. That's what we're doing. They feel terrible. So there's nothing for nothing in finance. Positive skew systems like ours, they feel like shit to trade, which is why you have to automate. They can be traded at higher risk targets without risk of ruin. And they work best in surprise regimes where weird shit that you didn't expect is going to happen, like the fucking SEC cracking down on Binance, like Sam Bankman-Fried being a scammer, like whatever weird shit is going to happen with crypto. We've had weird shit. It's positive skew is definitely the way to go. So the most important thing to understand about positive skew systems is they're hunting outliers. So this is 14,000 trades. Only 0.9% are 10R or better, 10 baggers or better. And 3.2% are 5 baggers or better. And there's many, many losers, but those losers are all small. So because we're hunting those outlier trades, luck is a big thing. Now, because we're hunting outlier trades, we have this positive skew distribution. The other type of trading is like mean reversion trading, lots of different stat arb trading, lots of different types of tradings, a negative skew. They have a higher win rate. They have a much higher win rate, but all the winners, these are the winners and these are the losers, are small, and the losers have a big tail. So negative skew systems, they make money consistently and then shit the bed right when you don't want them to. They have drawdowns that don't show up in backtests. Positive skew backtests tend to be quite accurate. Negative skew, you're just really taking big risks. Negative skew systems feel great to trade. So this is a carry, which is a benign negative skew system on the FTX perpetual futures. You can see it made money really consistently, shit the bed when the market did. Made money really consistently, shit the bed right when the market did. Made money really consistently, shit the bed. So negative skew systems feel great to trade. I'm getting a really high win rate, 65% wins, winning. But then they shit the bed sometimes. And this is the vast majority of bot trading. And you can make a bot look good in back tests by making it a negative skew system, which makes money consistently. You produce a back test showing that it makes money consistently and then it shits the bed right when you don't want it to. So negative skew systems have a high win rate without any big winners. They're generally they're convergent, meaning they're traders who built a model of the world where if that world is volatility, shape of the volatility smile, or an insurance model, or whatever it is, and when things depart from the model, they hope that it comes back to normal. They're analogous to selling insurance, and they have what's called insurance-like characteristics. You collect all your insurance premium, but one bad day you have to pay it all out. And so blending negative and positive skew strategies is the optimal solution for low drawdowns and consistent gains. But positive skew strategies are so simple and so robust and so hard to fuck up. That's why we started with. So here's our positive skew system, goes sideways for a while, makes a lot of money. Sideways for a while, makes a lot of money. Here's a negative skew system, the dotted line. Makes a lot of money really consistently, shits the bed. Makes a lot of money really consistently, shits the bed. Makes a lot of... So blending the two, that's the long-term play. So divergent systems, our trend following is about survival. Trend following, you absolutely will survive. Convergent systems are about satisfaction. They're about feeling smart, feeling good. Trading is great. I'm playing and winning. I'm winning 65% of the time. Success is the convergence of survival and satisfaction. This is our long-term play. So each customer has to choose a volatility target. The right target has a high probability of getting you to your financial goals, and it's something you can live with in the real world. So let's talk a little bit about Kelly criterion position sizing. So this is a formula for choosing the optimal trade size that maximizes the long-term compounding. And the only thing that really matters, like money talks, bullshit runs a marathon, real talk, is that at the end of the 10 years or 5 years or whatever you're doing it, is how much fucking money you have. Started with a little, do you have a lot? Everything else is bullshit. So you can see that here is our risk percentage, our volatility target. Here is our expected returns. So as we start out taking very low risk, we can only expect low returns. We can expect higher returns for taking more risk up to a point, and then it starts to roll over. Why does it start to roll over? It starts to roll over because if you get a big drawdown, if you get a 70% drawdown, it takes a long time to come back from that. And so your expected return goes down. So the optimal place is the peak of this Kelly curve. Now, this is for our traditional finance, our system on traditional finance markets, unfitted, which is about 0.95 Sharpe after costs. Now, this dotted line over here is the positive skew version. This line over here is a negative skew version. So a positive skew version of any system can be traded at a slightly higher leverage, and negative skew systems cannot be traded at as high leverage, cannot be traded with taking as much risk. Why? Because they shit the bed when you least want them to shit the bed. And you can see at 100% volatility target, we have to be lucky to make money. Even at like 70% of the volatility target, sometimes we're going to do really well and sometimes we're going to lose money. So the takeaway is it goes to an optimal point. This optimal point is your Kelly criterion. So full Kelly optimal position sizing on our system since 2018 was 57%. You might think that that's the optimum, but it's not that simple. It's only the optimal if the trading system performance is at least as good going forward as it has been historically. That's not an assumption that's sensible to make. Now, we have a statistically significant quantity of data, but that involves an assumption which could very well turn out to be untrue. So our worst case scenario should be that it does no better and no worse than bonds, FX, or other markets, which is this. That's how you be conservative. In this scenario, the optimal Kelly volatility target would be about 50%. But there's plenty of situations where someone would want to trade a lower than optimal target. You have a shorter time horizon to retirement. If you already have enough money, if you've won the game, if you have your retirement targets, this should be no more than 5% of your portfolio max. If you already have enough money, if you won the game, don't play. Don't fucking play. And in fact, if you have enough money for retirement, you should consider very carefully whether you want to even play the system. I would consider not buying this system. This is a system that's an aggressive system to get someone to retirement goals very, very quickly. If you have your retirement goals, this may not be for you. If you don't have a stable income, if you're doing some sort of internet side hustle, blogging, influencer, or you're a day trader, you're earning your living off the CSI, that type of income stream is highly uncertain. You need to back your risk. You're taking risk over here. You don't want to take extra risk over here. You want to back everything off. If you think I'm a little bit of a bullshitter, if you think I've been over optimistic, back it off a little bit. If you want to leave a margin for error, which is smart, remember the optimal volatility target is one you can live with and not get upset about, because you will have drawdowns. If you are naturally a risk-averse person, if you are a Volvo driving motherfucker, you want to back it off a little bit. Now, the last thing is, if this is all the money you've got in the world, if you're putting all your winnings into one thing and pitching it, back it off. If it's money you can't afford to lose, be conservative. Now, when would you want to trade a higher than normal target? If you're young, 25, 30, long time to retirement, fucking roll the dice, kids. If you've got a really high income, yeah, you can crank it. If this is a very small percentage of your total assets, if you think that the system will perform better in the future than it has in the past, and the only scenario that would happen is if crypto gets banned or if the government make a serious attempt to shut it down, this system will probably perform better than it has in the past because it has more risk. If you have a very high risk tolerance, if you have massive balls, you can push out the boat a little bit. And I'm looking at you, Ian. If this is an insignificant percentage of your total assets, if you've got multi-million dollars worth of assets and this isn't a big deal for you, you can push out the boat a bit. And if you can add more funds if necessary, you can go a little bit higher. So what we're going to do is we're going to use a simulator to spit out 10 equity curves for a system that performs like ours. And we're going to actually make it perform about 20% worse to be conservative. And we're going to look at the best, the worst, and the average curves from 10 randomly generated samples. And so right now, I bet all of you are thinking, fuck, I want over 100% a year. Let's just roll the fucking dice. And you may change your mind after this. So let's start with a very, very ultra conservative 11% volatility target. So our best result was 23% a year. This is the green curve. Our worst result was 11.3% at 11% volatility target. And our average was 16%. So the black is the average. And you can see that there's not much difference. So the ending money was, this is what, 17,000, 22,000, 27,000. There's not that much difference between being lucky and being unlucky. And let's not pretend that luck is not a thing. You're taking risk. What taking risk means is that you're going to have good luck and bad luck, and you might do really well and you might do badly. And if you are the bottom 10% of lucky motherfuckers, and you've taken a very conservative volatility target, you've still done pretty good. After 3 years, you've turned your 10,000 into somewhere around 17,500. So at 11% volatility target, the best result had the biggest drawdown. So it had an 18.6% drawdown. The worst result had a 13% drawdown, and the average drawdown was 8.2%. Now, our drawdowns were long. In the best result, had a year drawdown, had almost a year drawdown in the worst one, but the average one was 91. You can see how much luck there is there. Is everyone following along so far? Yes, these are Monte Carlo Sims. The black is the median, Mike, not the mean. You can switch it off at any time. Okay, so let's move up to a conservative, which is a 15% volatility target. This is lower than what most of you guys are going to use. So our average return goes from 16 to 21.8%, while our average worst drawdown goes from 8.2 to 15.9. And if we still look at our curves, these are all, if you gave me any of these three, so what it feels like is that you're just getting a lucky dip and you're getting, you know, one result out of a million potential results. If we look at our best result was a Sharpe of 1.9, amazing. Our average was a Sharpe of 1.9, 1.5, just what we expected. And the worst was still about Ray Dalio level. You can live with that. That's not so bad. So over 3 years, your 10,000 turned into about 19,000, 27,000, or 37,000, or 36,000. Starting to get. So at our ultra conservative target, the worst result is still objectively good. It's still as good as George Soros and Warren Buffett. Our average result is amazing. Very happy with that. And our lucky result is fucking brilliant. It's like touching on the best in the world. So luck doesn't come into play the more conservative you are. Now, taking on risk really means that you're more exposed to luck. Luck works both ways, right? Hit the red, get ahead, hit the black, set you back. Lower risk targets are less difference between lucky and unlucky. And I want you to never forget that taking on risk is fucking risky. There are no free lunches. Well, there's one free lunch in finance. So with a 25% volatility target, and this is about the minimum that most of you guys are going to be interested in. So on average, you're going to make 36% a year with a 28% maximum drawdown over the 3 years. If you're lucky, that goes up to 58.5% a year. That's amazing. But even that 58% a year, look at this big drawdown. You had a big drawdown there. And your unlucky result, 13.2% a year. Well, that would kind of hurt. That would hurt my feelings. So these are the range, top 10%, bottom 10%, average. Luck is a thing. At 35% volatility target, which I would consider as the standard for this type of investment for most people. So our lucky result is 124%. That's amazing. And look at this. It's got almost no drawdowns. You just got a dream run, fucking Yahtzee. Your biggest drawdown was 18.9%. Who wants 125% a year with under 20% drawdowns? Fucking everyone. That's a 3.5 Sharpe ratio. That's better than anyone in the history of anything. But that's lucky. Your average result is a Sharpe 1.6, amazing, 57% per year compounding, but you had a 47% drawdown that lasted 324 days. And your shitty result, still pretty fucking good, 28%, nearly 30% a year with a 53% drawdown that lasted 470 days and a 0.8 Sharpe ratio. Acceptable, but not great. So look at this. So our best result, dream come true. Our worst result, pretty good, but still probably a little bit hateful to sit through. Are you guys seeing that there's no free lunches in this? Tomorrow, how much do bull versus bear markets have an effect on returns? It does very well in bull markets and it does very well in bear markets. It does not do and loses money in sideways markets. This is the trade-off that we have to make. So how well does it do in bull versus bear depends on the strength. A strong bull market, it will probably underperform a degenerate trading, slinging altcoins in an alt season. Okay, so let's look at 50% volatility target. This is what I run, by the way. This is my personal thing. So this is aggressive, but not completely stupid. So our best result, 164% with a 37% drawdown. Hope for the best, plan for the worst. The worst result, 31.6% with a 61% drawdown that lasted 488 days. I could deal with that. I could deal with that because I've experienced 60% drawdowns and I know they're hard, but I would be able to get through that. Look at our Sharpe ratios. Our worst Sharpe ratio is now 0.6. That's hard to live with. Our average is 1.4, amazing. And our lucky boy, well, that's just luck. Now, one thing to notice, if we do these simulations out over 10 years, luck starts to become less and less of a factor. So they tend to converge to the mean over time, but not always, because if we get a 10-year sideways market, the system will probably underperform for that 10 years. If we get 10 years of super cycle, crypto is the new money, this is probably going to perform closer to the top. So we don't know the future. So let's run this volatility target again with a different set of simulations. And you can see that our best wasn't quite as good. Our worst was 43% and our average was 57%. I'd be happy with any three of those. Those are all 43% compounding over 10 years. You're rich as a motherfucker. But the drawdowns from excellent to testing your patience to hateful. Our Sharpe ratio is 0.9, 1.2, 3.3. So let's run that again. So this one, we've got some luck. Our average result is 97%, 100% a year compounding, turning 10,000 into 10.2 million in 10 years. Our best result is like so much above that it's retarded to even think about it. I wouldn't think anyone could expect to be that lucky. It could happen. I wouldn't expect it. Our worst result, 31%. I can live with that over 10 years. It's still pretty good. It's still a 13x return over 10 years. That's pretty fucking good. And our Sharpe ratios from 0.7, which is acceptable but hard to live with, to fantastic, and 3.6, so good you won't see it in the real. Now let's run a degenerate simulation. Once we go past the peak of that curve to 60%, our worst result, lost 5.8%. So you still have your money, but you lost 5.8% a year. So you're probably down about 25% after 3 years. And you can see that none of our previous simulations, and each one of those pages that I've shown you is 10 random simulations. So out of what? 1, 2, 3, 4, 5, 6, 7. Out of 70 simulations so far, none of them have lost money until we got to 60%. So 60% is where, oh, fuck, you're taking a very real risk of losing money. And what do you get for taking that risk? Well, hit the red, get ahead. You got 300% per year. If this system makes 300% a year and you're running at 60%, you are a very rich person. Bottom 10% of results, you're losing a bit of money. And your average is doing 90% a year. Amazing. What sort of drawdowns are you putting up with? Expecting 60%-ish drawdowns. And you're expecting long drawdowns, 500 days. So look at the difference between best and worst. Look at our average is still 1.5, but you might get lucky and get 4.9. No one's getting that lucky over 10 years. Over 3 years, you might get that lucky. But over 10 years, the luck is going to medium back to somewhere around here. But in the 3-year worst period, you might be fucked up. So now I want you to run some simulations. So I'm going to put this URL in the chat. This is not my simulation, by the way. This is my great friend and mentor. His name is James Hodges, and he goes by the Robot James on Twitter, and he's a fantastic follow. I highly recommend everyone following him. He has taught me so much about trading, and I actually pay him to learn to trade off him. And you can imagine how good someone is if I want to pay them to learn from. So let's go to that simulation. And to match my numbers, what we want is a volatility target that is 1.52 times. So what we're going to do is let's look at let's do a 50% volatility target.
Oh, sorry to interrupt. There's some people in the chat really interested in just a little bit more information on what is the annual drift and what is the seed. Okay. So let's go through this. So what I want you to put in is 76. 70 annual drift is the average compound, is the compound annual growth rate. It's a technical term for that. Annual volatility is your annualized volatility. Annualized volatility is your daily volatility multiplied by the square root of the number of trading days in a year. And even though it's not the same in crypto, by convention, people divide it by the square root of 262. I hope you're fucking happy now. You made me do some maths. So what I'd like you to put in is an initial capital of 10,000, the top number, 76% per year, the annual volatility of 50%, and your seed, we can change this around. So we can pick a number, just tap in a number and we get a different simulation. So this one, we've got an average of 80%, a best of 130, a worst of there. Now we change it to a different seed. And you see we've got a totally different result. Is everyone cool with this? This is what's called a geometric Brownian motion simulation, and the seed is a start for their random number generator. So the seed just makes it random. So just pick a random number. It could be anything. I just whack in the numbers and we get a different result. Okay, so Ian, maybe you can open the floor now and we get someone to, and we ask someone who's willing to share their screen or talk and tell what they think about this. And then we're going to change the numbers and see how they feel about it. And what we're looking for is something that we can live with if it's the worst case scenario, that we really can live with. And then we're going to add a margin for error.
If you can't live with this system is no help to you. If you can't deal with the long and deep drawdown, you cannot trade at a high volatility target. That's just the way it is. And trading systems don't get any better than this. So anyone who tells you that they can give you returns without taking risk is just lying to you, and I refuse to lie anymore.
Absolutely. Okay, then. So we're looking for somebody that is willing to come on, share their screen. So all CSI people would have done this on a hot seat coaching call. Share the screen, have the calculation up, run some different simulations, and chat with Scott. So we got Mike Winkle with his hand up. So I'm going to assume, Mike, that you're ready to go and share your screen and go through this with Scott. So I'll need to promote you to a panelist, Mike, so that you can share screen. I'm doing that now. You'll need to accept it. It'll take a few seconds, and then you'll see the share screen function is then available to you. So you're just switching over now, Mike, and then just unmute your end and you're on with Scott.
Yeah, I just have a question. I don't really have results to share. Is that okay?
Oh, sure, of course, Mike.
So Scott, I understand from a Monte Carlo simulation what's going on here, and you're coming up with 10 results and you're showing the maximum, the minimum, and the median and all that. And it's based on this volatility.
There's also an approximation there. This is for a neutral skew system. So our skew system is slightly different. It's slightly better. It's a positive skew system, but anyway, it's close enough.
Right. So if somebody changes, you're going to ask us to establish a volatility as a parameter.
As a parameter in the system. And
the system. So what is it? How is it assessing volatility of each of these coins or the portfolio, or what happens if you change the volatility? How does it reduce the risk if you're lowering the volatility, or how does it increase the risk if you raise the volatility? What is happening?
Okay, so let's jump under the hood a little bit. That's a really good question.
Okay, thank you, Scott.
Where's my Okay, so let me explain. So the first thing that happens is that we're taking a volatility forecast for each coin for tomorrow. Now, it's trivial to forecast volatility for tomorrow. There's a number of models like Garch and things like that, but really what gets us close enough is an average of the last 30 days of volatility and the last 100 days of volatility in a 70-30 weighting towards recent volatility. So we can and have predicted volatility for tomorrow with 95% accuracy. Now, because of I'm going to get a bit nerdy here, but because of a thing called the law of conservation of difficulty, it's very easy to predict volatility. It's very hard to make money from. So what we're doing is we're saying, okay, Bitcoin, we've got a signal strength of whatever we have. Today it's 16.4, and we've got a volatility of whatever we've got. We're going to compute the perfect Bitcoin position size for today. Then we're going to compute the perfect Litecoin position size for today, the perfect ADA position size for today, and so on and so on and so on. We're going to add up all those position sizes for today and go, okay, if we took all of those, what total portfolio volatility would we have? And then we're going to run that through a mathematical calculation that says, what portfolio level volatility do we want? Now, when we talk about what is annualized volatility mean, so a 25% volatility target annualized means that we want a daily standard deviation of 25 multiplied by the square root of 262. And so what that gives us is that a one standard deviation move will be about, from memory, I haven't done the calculations in a while, about 1.3%. So in other words, that a normal wiggle in your account at 25% will be about 1.3% up or down. And a two standard deviation move, a big move, a move that happens, once or twice a month, that's going to be somewhere just under a 2% move. And a 1 in 100 day move, something that happens 2 or 3 times a year, is going to be about a bit under 5%. So that's how we calculate the individual coin position sizes. We run this through an overall volatility target. And what are we trying to do here? What we're trying to do is the big problem with trading is that sometimes what's inside the box doesn't match what was on the label. So what are we really trying to do? We're trying to say, well, as close as possible, I want to get the risk that I'm willing to take. If I'm willing to take this amount of risk, then fuck yeah, like fuck it, we ball. If I'm not willing to take the risk, then I'm willing to take the risk that I'm willing to take. What we absolutely don't want and what's unacceptable to have is if we think we're taking a certain amount of risk and we're actually taking much more risk, like that's a disaster. Or if we want to take a lot of risk and we don't actually taking a lot of risk, that's actually a disaster too, because it won't get us to our goals. So risk is luck. Luck works both ways, it works good and bad. And there's no getting around that fact. There is no universe where anyone can tell you that I've got a bot that does this and you put in this and it's guaranteed to get you out that. That's fucking nonsense. Grow up. What we are doing is taking a certain amount of risk. And the amount of risk that we're taking ought to be calculated to have our account wiggle a certain amount. So if you are comfortable with your account wiggling 2 to 3% per day, still a lot less than Bitcoin actually wiggles, right? You know, Bitcoin can be a 200 or 300% a year volatility during a bull market. So annualized volatility of Bitcoin on average has been over 100%. So as a general rule, even the most degenerate volatility targets are still under half what you would experience with buy and hold Bitcoin investing, and about on average, about 20% of what you would experience with buy and hold altcoin investing. Does that make sense?
Yeah, that's
I've just gone over everyone's head, haven't I? I've just fucked everyone.
it's all right. It's all right. The
All right, you
recording,
gotta stop me when I do that shit.
we can pick through this for weeks. Okay, is there anybody else? I've seen a few hands going up.
Is there
and
anyone
coming
that's got
down.
a question that's actually going to resolve people's problems and not just create more problems for everyone? Sorry, guys.
Okay, so we got Tom is on the microphone.
Give it up for Tom, yay. Mark has a good question. Let me just jump in. This is why we don't use stop loss. We don't use stop losses because stop losses are inefficient. And if we, let me just jump in quickly and show you what's better than stop losses and why we don't need them anymore, is that when this signal goes to zero, we're out of the position. So there's no universe where it hits it and then we just jump off all of our position. Why? It's very inefficient in terms of costs. We're jumping in and out of hundreds of positions, all in, all out. That's very efficient cost-wise. And it doesn't reflect the way that we really feel about it. So if you think about how you would feel about being short here, you'd feel really good about being short, feel really good about being short. Oh, wow, this is looking a bit sketchy now. Not feeling so good. But there's no, oh, it hits my stop losses here and then I change my view. What happens in reality is I'm a bit nervous. Now I don't really want to be short anymore. Now I want to be long. So by eliminating stop losses in favor of continuous forecasts, which is what every single top tier algo firm does, from Jane Street to Sigma, Radix, every single top tier algo firm. They all do it this way. If you walk into Jane Street or Jump Capital and say, oh, I want to build a trading system with stop losses, they'll just laugh at you and escort you straight to the door. It's 1980s, 1990s technology. It is absolutely not in use anymore. And you know, this was a great surprise to me, but that's the reality of it. Okay, moving on. And you also can't be stop hunted, which is a favorite trick of institutional investors in other markets, which is a very good point. So the vast majority of institutional alpha trading is looking to trade against price insensitive or trapped traders. The very definition of a price insensitive trader is an algo saying, oh, hit your stop loss, market, sell. If someone sees that, they can trade right against you. They can push it down to that point, trade right against you, hunt your stop losses, all's fair in love and war. Like you just can't be exposed to letting the most ruthless, the most cunning, the smartest people in the world hunt your stop losses. It's highly inefficient. Okay, moving on. Sorry to interrupt, Tom. Sorry, Tom, I interrupted you there, dude.
I think we're kind of coming to a natural sort of conclusion here, Scott. There's been,
Right.
you've answered so many questions for almost 90 minutes now, dude, and I think you kind of covered. Dennis has popped his hand up. I'm just going to unmute you now, Dennis.
I might just get to some conclusions. So I'm hearing you loud and clear that I'm boring, motherfuckers, and so we will just jump to the conclusions. Okay, so the summary is that most of the people with not all of their net wealth in crypto, you're going to run vol targets of 35 to 50%. This is the range. Maybe 25% if you're really risk averse. The lower your vol target, the lower your returns, but the less difference there is between lucky and unlucky. The expected return increases up to about 57%, then it decreases. And if you keep increasing it beyond that, you face a very real risk of losing money until about 65%, and then a very real risk of losing all your shit, losing all your capital. Don't do that. Whatever target you think you can handle, size it down a little bit, please. It's not sensible to try and maximize returns if you're going to hit your personal uncle point and puke your capital in a drawdown. If you think that I'm optimistic or that I'm some sort of marketing bullshit or I've overestimated things, size it down a little bit. The longer you trade the system for, the more good and bad luck even out. And 25 to 50% is about the range, in my opinion. If you're looking at less than 25%, crypto probably isn't the right home for you. You're probably a stock guy in your secret heart. 60% is very aggressive. I'd allow it for the right person, but you need to understand what you're getting into. I'm at 50%. That has no risk of blowing up and optimizes my long-term wealth creation function. It is quite literally slightly less than the mathematically optimal solution, with a bit of margin for error. That might be hard to live with for some of you, and that's just being honest. If you can't handle a 50% drawdown, it's not for you. And if this was your whole bankroll, that wouldn't be cool unless you were young. So whatever you think you can handle it, size it down. Okay, I think we're getting to the end, right, guys?
Yeah, that's been a really amazing session, Scott. And we're just about 90 minutes, and yeah, I think we'll just call it there then. So the recording will obviously be in the group, transcript, stuff like that. Takes a few hours to upload. Stick with us. Okay, and I would encourage you all. You've only got until Tuesday to decide. So please get your calls booked at finrev.trade/call. And everyone gets a slot on the onboarding, Marlon. We're onboarding 10 people a day. We want to make sure that everyone gets personalized white gloves experience. No one's going to be on their own through this process. We want to walk you through absolutely every step. It's critical that we make our customers happy. It's critical that everyone gets it right. It's critical. We're only selling 200 of these, by the way, and it's critical that we have 200 success stories and 200 people who meet their life goals and make a lot of fucking money with this. So this is the best system that I can possibly design. This is it. There's not going to be next year does another launch with a new system. It ain't going to be like that. This is it. This is the way that I recommend that you trade for years and years, if not decades. And it's the way that I'm trading with the vast bulk of my own money now. I'm all in on trend. I'm all in on trend in crypto, and I encourage you to be the same. KuCoin is next up. Where is it on the listing? I think it's second or third next. It is. It's one of the absolute priorities. Yeah, I fucking love KuCoin. All right, guys. This is the tits. You should buy it. All right. See you guys. Awesome. Thank you, Scott. Thank you, everybody. See you in the group.